Picture a three-story tower. This is the AI industry right now. Floor 1, the GPU chip makers, led by NVIDIA. Floor 2, the companies buying those chips to build AI data centers. Think Oracle, CoreWeave. Floor 3, the companies actually building the AI models, OpenAI, Anthropic. It sounds like a solid structure, but underneath, there are deep, dangerous cracks. These companies are piling on debt just to keep running. They're not making profits to match. Most are still bleeding money, and yet their valuations are through the roof. Take CoreWeave, an AI infrastructure company. $56 billion in debt. That's 1.5 times Iceland's entire GDP. For every dollar of stock, they owe $88 in debt. OpenAI has not turned a single dollar of profit. It's actually projected to lose $14 billion this year alone, and yet it's valued at over $850 billion. The tech revolution is real, no question. But hiding behind it, is there a dead bomb wearing an AI costume? Stick around and you'll come to your own answer. Welcome back to Why Money, where economics becomes simple, interesting, and won't put you to sleep. I'm Kay. AI's meteoric rise is reshaping the entire economy and financial markets. At this point, that's not even up for debate. From a money flow perspective, everyone's piling into AI stocks. That's dragged entire stock markets to new highs. The US, Japan, South Korea, and plenty of others. From an economic growth perspective, according to the BIS, AI has added an average of 0.4 percentage points to US GDP growth every year since 2022. But that pace is accelerating fast. In just the first half of 2025, according to JP Morgan, that contribution jumped to 1.1 percentage points, which is exactly why, if the AI bubble is real and it pops, we're not just talking about a few tech companies losing money. We're talking about economic growth, the stock market, and the savings of investors around the world. So let's dig a little deeper. I like to think about AI industry as 3 floors, and the rest of each floor is completely different. Floor 1, chip makers. These are the companies making the hardware, the GPU chips that power AI models. The names here, NVIDIA, AMD, TSMC. This group is making serious money because anyone who wants to build AI, whether they succeed or fail, has to buy their chips first. Here's NVIDIA's stock chart. It tracks the AI boom almost perfectly. Back in 2022, before ChatGPT existed, the stock was sitting around $12. Then ChatGPT dropped, the AI frenzy took off, and NVIDIA became a superstar. If you'd bought and held in 2022, you'd be sitting on nearly a 20 times return today. If you need an analogy, NVIDIA is the company selling picks and shovels during a gold rush. Whether the gold miners strike it rich or go bust, the shovel seller still gets paid. Whoever controls the GPS holds the fate of the entire industry. Floor 2, data centers. This group buys chips from companies like NVIDIA and builds massive data centers to power AI models. But right here, we already split into 2 groups with very different risk levels. First, the diversified players. Microsoft, Amazon, Google, Meta, they already have hugely profitable core businesses, and now they're expanding into AI on top of that. Think of it as walking on 2 legs. If AI slows down, they've still got a life raft from their old business to fall back on. Second, the all-in players. These companies are focused entirely on building AI infrastructure. There's no other business line to fall back on. CoreWeave, Nebius are the names here, far riskier. I'll break down their debt model in detail later in this video. So don't forget to hit like and subscribe so you don't miss it. Thank you. Floor 3. The companies building the AI models you and I actually use, like ChatGPT, Claude, Grok, the big names here, OpenAI, Anthropic. Now let's break down the specific risks on each floor. There are a few details here that might genuinely surprise you. AI is an expensive race, so who's actually footing the bill? There are 4 main sources: company cash on hand, issuing stock or bonds, bank loans, And one source that's suddenly very popular, private credit. Put simply, this is when private funds lend directly to AI companies, cutting traditional banks out of the picture. Both sides negotiate the interest rate, terms, and repayment schedule themselves, and none of it has to be made public. So not every private credit deal gets disclosed. That creates a blind spot in the data. The real debt numbers could be even bigger than what we can see. According to the BIS, private credit lending to US AI companies went from basically zero to over $200 billion in just a few years. The pace of borrowing is staggering. On top of that, AI's share of the entire global private credit market jumped from under 1% to nearly 8% in just a few years. Investment funds are pouring more and more money into lending to this sector. Borrowing that much while having no profit to show for it is a deadly trap. What makes it worse is how these companies have built entire business models on top of that debt. Let's dissect one example. CoreWeave started out as a crypto mining company. Nothing unusual there. When the crypto market crashed in 2017, they took the GPUs they'd been using to mine coins and pivoted into AI infrastructure. And here's the first twist. They borrow an enormous amount. CoreWeave's total debt now sits at nearly $52 billion. 1.5 times Iceland's annual GDP. For every dollar of their stock, they owe $88 in debt. That number alone tells you how alarmingly leveraged they are. And it's been climbing steadily since 2023. They keep borrowing more at a bigger and bigger scale. Their multi-billion-dollar lenders include names like Blackstone and Magnetar. At interest rates ranging from 7% to 15%, that's a massive cost. In Q4 2025 alone, the company paid over $250 million in interest, while operating income was just $19 million. Of course, CoreWeave is not the only one. Borrowing like this has become a widespread trend across the AI industry, which brings us to risk number 2, fragile collateral. To borrow from private credit funds, you need collateral. And can you guess what these companies usually put up? The GPU chips themselves. These are devices that lose value and become obsolete fast, often within just a few years, because NVIDIA keeps releasing newer, more powerful chips. Let's get specific. CoreWeave pledged GPUs as collateral to borrow over $2 billion in 2023. Then $7.5 billion in 2024. Most recently, $8.5 billion in March 2026. An enormous pile of debt, 1.5 times Iceland's GDP, backed by a stack of GPUs that's losing value by the day. And the bad news again. CoreWeave is not a one-off. This has become a fairly common way for AI infrastructure companies to raise debt. Some finance analysts have even coined a name for it, collateralized chip obligations, which sounds a little too close to CTOs, the financial instrument that helped trigger the 2008 crisis. Almost every AI infrastructure company is living off a handful of customers. Look at CoreWeave again. In 2024, 62% of its revenue came from Microsoft alone. It's since expanded contracts with Meta, OpenAI, and Anthropic, but that's still an extremely concentrated customer base. And here's the thing. Both Meta and Microsoft are actively researching how to build their own AI infrastructure in-house. Not great news for CoreWeave. Same story with Oracle. OpenAI alone accounts for nearly half of Oracle's total backlog. And here's the kicker, OpenAI has never turned a profit. On top of that, there's another problem. These loans are backed by contracts that have not happened yet. Here's an easy way to picture it. Oracle has a $300 billion contract with OpenAI over the next 5 years. That's roughly Finland's entire annual GDP. Even though Oracle hasn't received a dime of that money from OpenAI yet, it's already borrowing hundreds of billions of dollars right now to build the infrastructure. Bottom line, infrastructure companies like CoreWeave and Oracle are taking on massive debt because they believe their partners, OpenAI, Microsoft, will keep growing and pay exactly what they promised on paper. If that plays out, this will go down as the most successful infrastructure build-out in tech history. But if just one link in this chain breaks, the whole thing could unravel. If OpenAI fails to grow as expected, Oracle could get stuck holding massive data centers with no easy replacement customer. And behind Oracle's mountain of debt sits a web of banks and private credit funds, a tangled, interconnected chain of risk. Try to picture this. A company signs a $300 billion purchase contract, an entire country's annual GDP. But that company has never made a single dollar of profit. Sounds absurd, right? But that's exactly what's happening. The companies on floor 3, the ones behind ChatGPT, Claude, are living a huge paradox. Sky-high valuations, zero profit. OpenAI is projected to lose about $14 billion in 2026 alone. Internal forecasts say it won't turn a profit until 2030. And yet, it's committed to spending $1.4 trillion on infrastructure over the next 8 years. Anthropic, the company behind Claude, has faster revenue growth, but it doesn't release audited financials either. Nobody actually knows if it's profitable or still burning cash. So, where's the money come from to keep them alive? The answer: non-stop fundraising and debt. Even while losing tens of billions a year, OpenAI still has an unsecured credit line worth nearly $5 billion from Wall Street's biggest banks, JP Morgan, Citi, Goldman Sachs, Morgan Stanley. At the same time, it raised another $122 billion in funding. Neither OpenAI nor Anthropic is publicly traded, but through private funding rounds, OpenAI is valued at $850 billion. Anthropic is valued at nearly $970 billion. Buried in debt as they are, they're still valued on par with massive, decades-old tech giants that have been profitable for years. That valuation rests entirely on a bet about what these companies might become. And nobody can predict the future with certainty. So that's the full picture of floor 3. Heavy losses kept alive by debt and endless fundraising, yet valued by private markets at levels that are almost hard to believe. And a lot of investors are now waiting on one event, the IPO, when OpenAI and Anthropic finally go public. You all think floor 1 is safe, right? But floor 1 isn't immune either. Finance folks call this risk circular financing. Here's the simple version. NVIDIA invests in or lends money to AI infrastructure companies. Those companies then turn around and use that exact money to buy NVIDIA chips. NVIDIA books that as chip sales revenue, which pushes its profit and stock price even higher. And here's an example. In early 2026, NVIDIA poured $2 billion into buying more CoreWeave shares, becoming one of its largest shareholders. CoreWeave then used that money, plus billions more in debt, to buy NVIDIA chips. This pattern repeats itself across multiple deals with multiple companies. At his office, CoreWeave co-founder McBee put it flatly: there's no risk at all. But is reality that optimistic? So all 3 floors of the AI industry carry their own distinct risks. Let me sum it up quickly. Floor 1, chip sellers. They're genuinely profitable right now, but the money they invest or lend out often comes right back to buy their own chips. Revenue climbs, the stock price climbs. The numbers look great, but is the situation really that good? Floor 2, infrastructure and data centers. Think CoreWeave, Oracle. They're drowning in debt, dependent on a handful of big customers and contracts that haven't even materialized yet. Floor 3, the
the AI models like ChatGPT and Claude. These companies have never turned a profit and survive on debt and constant fundraising. Yet they're valued sky high, purely on massive expectations and faith in the future. According to the Minsky bubble model, inspired by economist Hyman Minsky, every financial bubble moves through 5 stages. Stage 1, displacement. It starts with a spark. For AI, that was the launch of ChatGPT in 2022. Stage 2, boom. Prices rise, the media takes notice, more and more people jump in. Everyone's afraid of missing out on getting rich, so the money keeps pouring in. Stage 3, euphoria. Everyone believes prices will just keep climbing, and warnings get ignored. The clearest sign, people start using leverage and debt to buy even more, sending prices climbing even further. Stage 4, profit-taking. A small number of clear-headed investors start selling. The bad news is, most of them are institutional funds, whales, and veteran investors who've lived through bubbles before. Everyone else is still riding the euphoria, expecting prices to keep going up. Stage 5, panic. Prices reverse, everyone rushes to sell, and it cascades into a full collapse. The bubble bursts. A lot of people lose their assets and end up in debt. It's genuinely hard to pinpoint exactly where we are right now, but based on everything we've broken down, we're probably somewhere in stage 3, euphoria. Whether this actually turns into a full bubble depends on whether these AI companies can eventually deliver real profits. But the risk right now is real, and it's already showing up clearly. In January 2026, Senator Elizabeth Warren sent a letter demanding an investigation into the risks tied to over $1 trillion in debt expected to flow into AI infrastructure, warning that if AI companies can't grow revenue fast enough to service that debt, it could trigger a financial crisis. In June 2026, the BIS, the central bank of central banks, warned that the AI investment frenzy is forming into a bubble risk. Some US banks and investment funds, like Blue Owl, have pulled back from data center projects tied to Oracle. S&P downgraded Oracle's credit rating to BBB-, just one notch above junk status. The AI industry's debt has become so layered and interconnected that even the official statistics might not capture the full picture. Nobody can predict a financial bubble or exactly when it'll burst with precision. Every bubble is tied to a different asset: tulips, internet stocks, real estate, and each one behaves completely differently. Personally, I think the AI bubble risk is real, and the signs are fairly clear. South Korea's stock market actually crashed back in June this year when AI stocks took a sharp hit. So as a long-term investor, I'm choosing to hold cash and wait for genuinely good opportunities. And if that opportunity doesn't show up, that's fine too. Opportunities always come around again. Pouring money into AI right now just feels too risky to me. So here's what I'm personally doing. Cutting stocks in floor 2 companies, the ones over-leveraged, dependent on a few customers, and betting on future contracts. If I'm holding floor 1 stocks that are already profitable, I'll consider locking in some gains. At the very least, pulling my original capital back out. Then sit on cash and wait. After every major crash, asset values can drop by as much as 80%. Shaky, over-leveraged companies disappear. Only the genuinely good ones survive. And that's exactly when we get the chance to buy great companies at a discount.
But of course, nobody can be certain about the future.
I could be completely wrong about all of this, and I'll own that if I am. So please don't take any of this as investment advice. What's your take? Drop it in the comments.
Thank you for watching this video. See you next time. Bye!